Hello everyone and welcome to this January 11th edition of Property Perspective. Today I'm with Matthieu Arseneau. Hello Matthieu.
Hi, Smo.
And Andrée Desrosiers. Hello Andrée.
Bonjour.
Our topic of the day, mortgage refinancing. But before we go into that discussion with Andrée, I'd like to go back with some declarations from either the Fed or the Bank of Canada with you, Matthieu. Remember, in December, the Fed telegraphed larger interest rates cuts in 2024 than in September. Obviously, it was enough for giving a lot of gas on the scenario, the soft landing of the economy. Do you think investors are right to be so excited at the moment?
Small, it's good news. Okay, there has been improvement in the inflation backdrop. The Federal Reserve is now open for more rate cuts, but we remain cautious on our side with our economic scenario. We still expect contraction of the U.S. economy in 2024. We have to keep in mind, and you can see that on the chart, okay, Federal Reserve is now expecting 75 basis points of rate cuts, but market is now expecting 140 basis points of rate cuts, so more than what the Fed is expecting. So either of the two scenarios, if they materialize, it doesn't mean that we are out of the wood yet. If you look historically, in fact, in each of the last 4 recessions, the Federal Reserve cut interest rates before it happens. So it's still a perilous situation, given that even if we get those rate cuts, monetary policy will remain restrictive on an historical basis and will have a negative impact on the economy, on our view.
Okay. And Matthieu, in Canada, despite signs of weakening of the economy, we heard Bank of Canada continuing saying we might raise interest rates again. Is that serious?
Clearly, I've been surprised if in December perhaps what the Fed was saying should have been what the Bank of Canada have said, but it wasn't the case. They are still hawkish in their tone. They want to be sure that they will contain inflation, but there has been pretty good news on the inflation front in Canada. If you look at the chart I'm showing right now, in the 3 months ending in November, in fact, when you look at the 55 components of the CPI, in fact, just 25 components were increasing above the 2% pace over that period. So that's very low, and very low compared to the 47 that we saw back in 2022. You can see that on the chart. And if you look at core inflation, when you exclude the most volatile components, that's what the Bank of Canada is tracking. Over the past 3 months, we are running an annualized pace of 2.4%. That's pretty close to the 2% target. So that opens the door for rate cuts in our view, starting in April. So that's the good news. The bad news is perhaps this weakness in inflation is due to a weakening economy that we're currently seeing. We talked about it. GDP growth is very, very weak. So we saw even contraction in Q3. Labor market hiring is not following the pace for population growth, and we are seeing with the employment rate of the prime age worker cohort, the 25-54. The downward trend we are currently seeing. In fact, the employment rate is at its lowest level in 23 months, but more worrisome is what is going on with the youngest one, the 15-24. We are seeing a drop of 3 percentage points in the employment rate. The only moment we saw that kind of weakness, it was in recession historically in Canada. So clearly there's a weakening economy still in December, and we expect that to continue, and that's opened the door for a first rate cut for the Bank of Canada in April. Before the Fed, we think it's going to be much more at the end of the second quarter on the Federal Reserve side.
Okay, thank you, Matthieu. Last question for you. In anticipation of rate cuts in Canada and in the States, we saw recently 5-year mortgage rate decreased. Is that a good sign for the real estate market?
Clearly, it gives some oxygen to the market. 50 basis point on the 5-year mortgage rate since the October-November peak. I'll say that for December, it's mixed performance. Toronto bouncing back in terms of resale market activity. Calgary increasing as well, but Montreal and Vancouver declining. But if you look at the past year, so 2023, we have 11 months, so almost the full picture. It's the worst performance in 15 years in Canada in terms of resale market. That's what I show here. So people are wondering, are we going to see a rebound in activity in 2024? We're not that much optimistic for the first half of 2024. Yes, rates decline, strong demography, but we don't have this momentum in the labor market that could help the housing market in such a context. And we have to keep in mind that affordability remains an issue at current mortgage rates. So it's still restrictive and still a level of affordability which causes a problem at this point. So maybe we'll have to wait for the second half of 2024 with job gains, job creation coming back and lower rates. But we'll see. But so maybe improvement, but in the second half of 2024.
All right. Thank you, Matthieu, for very clear explanations. Let's now discuss with Andrée about certain aspects to consider before refinancing your property. Andrée, you spoke to us of the importance of having a budget, I think a couple months ago, especially given the context of high inflation, rising interest rates. If I remember correctly, you told us that updated budgets are essential to ensure that we're well positioned when facing mortgage payment increases, which in some cases, as we all know, may be significant. But really, Andrée, where should we start?
That's a very good question, Simon. But before I answer it specifically, I would like to share with you some interesting statistics that I've seen. Did you know that only half of Canadians make a budget? In fact, it's 49% of them. Those who do so, though, are half as likely to default on their financial obligations. And people who take the time to do a budget repay their mortgage faster, as well as their other debts. So, as you can see, budget is a simple tool that is available to everyone and that can make a difference if you take the proper action in order to improve on your financial situation.
Yeah, you're right, Andrée. Statistics speak from themselves. So Andrée, if following the budgetary exercise, we see that we need to do something, obviously, to be able to afford our new mortgage payments, what exactly can we do?
In fact, Simon, once your discretionary expenses have been removed or reduced from your budget, expenses such as restaurants, subscriptions, things like that, if it's still not sufficient, then we must look at the debts. First of all, as you are a homeowner, do you have equity in your property? Equity is the difference between the actual market value of your house less your mortgage balance. Let's take an example to simplify everything. Let's say you bought a house in June 2020. You paid $400,000 for it, and you took a mortgage of $350,000. Okay? Today, 3 years and a half later, your house is worth $500,000. And I'm not exaggerating here because since the pandemic, meaning, since March 2020, the property prices have increased by more than 25%. So your house that you bought in June 2020 at $400,000 may very well be worth now the $500 that we are using in our example. So if we take this $500, We subtract to it our mortgage balance, which is $350. And here again, I'm being conservative because you've made payments since then. But, you know, to make it simple, we're going to keep the $350. So you have an equity on your house of $150,000. Thanks to this equity, Simon, you can refinance your property and thus free up, you know, liquidity that will allow you to repay some debts that you have on your in your budget. Car loan, for example, or credit cards. We have to keep in mind, though, that when we refinance our house, we cannot go higher than 80% of its market value. So again, if we go back to our example, our house that is worth now $500,000, 80% of that is $400,000. So if your mortgage balance is $350,000, that gives you an equity or a liquidity that you can use to repay debts that can go as high as $50,000 if you decide to refinance to the maximum of $400,000. And with these liquidities, we always suggest that you pay first the debts where you have the highest interest rate, again, like credit card or the type of loan, you know, buy now, pay later.
Are there any fees, Andrée, associated with refinancing?
There could be some fees. For example, we may ask for an appraisal to confirm your market value of your house. The average price of this appraisal, as we said on an earlier capsule, is $350. Also, if we cannot use your mortgage deed that you actually have on your property, then there could be legal fees. That will be something around $1,500.
Okay, interesting. And what if, Andrée, we don't have enough equity to refinance? Is there other solution or solutions to help us?
Yes. There's other possibilities for you. First, if you have a line of credit, you can use it to repay some commitments that are bearing highest interest rate than the one you're paying on your line of credit. That's one thing that you can do. If your credit allows it, you could also consider consolidating your different debts to have only one monthly payments, so that will help you as well. And finally, as a last recourse, you know, if you have investment, you can cash them and repay your debts. So as you can see, there are many choices available to you. The important thing, though, is to discuss them with your advisor to make sure that the choice you make is the right one for you.
Thank you, Andrée, for your very pertinent suggestion. And thank you again, Matthieu, for your presence today.
Thank you, Simon.
I hope you all enjoy today's program and join us again very soon for our next edition of Property Perspective.